We're coming off a great year for the S&P 500 index in 2017, but we're already a quarter of the way through 2018 and it's time for an update on how the index has done so far this year. Here's a plot of the first quarter, and as you can see, the index has not done so well. In fact, it is down slightly since the start of the year by a little more than 1%. In addition to being down slightly at the end of the first quarter, we saw some fairly active swings both up and down in the value of the index. This volatility has been at the center of much of the financial news lately, but just how volatile was the first quarter? Here's one way to look at it that I find helpful. This again is the same plot from episode 1, which shows how a dollar invested in the S&P 500 index at the start of each decade performed over the course of that decade. The 2010s are in gold, and as you can see, the level of volatility relative to some of the other periods in the past isn't quite as extreme in this view. In this broader look, things don't appear quite as dramatic or out of context. The index has seen this kind of activity in the past and will likely see this kind of activity again in the future, but it does seem to generate some news and interest. Here's our favorite long-range plot since 1950. Note the recent wobbles relative to the tech bubble and the Great Recession. Switching gears a bit to a key event for investors, which always occurs in the first quarter of every year. Namely, Berkshire Hathaway publishes its annual letter to shareholders. These letters, written by Warren Buffett, are always full of insights and wisdom for investors, and this 2017 letter is no exception. Warren gives a final tally and accounting of the bet that I discussed in episode 1. The results are so important for common investors that I can't reiterate them enough. And the fact that Warren Buffett dedicates so much of his annual letter to the bet should not be lost on any investor. He is making a very profound statement. Here's Warren Buffett's final scorecard of the results as shown in the 2017 letter to shareholders of Berkshire Hathaway. There are some eye-popping numbers on this page. Buffett's pick more than doubled over the 10 years with a total return of about 125.8%, which equates to an average annual rate of return of about 8.5%. This is even with the decline in 2008 factored in. Further, not a single fund of funds beat the S&P 500 index over the 10-year stretch, let alone the aggregate of the funds. In fact, none of the funds of funds really even came close. Another stunning result is that very few of the funds of funds beat the index in any given year over the course of the bet. I've highlighted the years where some of the funds beat the index. These funds are run by highly paid investment professionals with advanced education and degrees, years of investment experience, and access to all sorts of information, data, and people. They spend 8 hours a day or more researching and analyzing, and yet they could not beat a low-cost S&P 500 index over a 10-year period. As an average investor trying to get ahead in the world, I feel excited and empowered by this scorecard. Picking a low-cost S&P 500 index fund does not require any special expertise and does not require massive amounts of research or time. It's easy to do. After all, we have day jobs, families, etc. Knowing that Warren Buffett endorses this investment strategy and has provided this final tally certainly gives me peace of mind. For those interested in learning more and understanding why Buffett was so confident that he would win this bet, I would point you to a section titled How to Minimize Investment Returns on page 18 of the 2005 letter to shareholders of Berkshire Hathaway. In this section, Buffett tells a story of a fictional family called the Gottrocks and how they went about investing. Keep in mind, Buffett wrote this all the way back in 2005, roughly 13 years ago. It's just as relevant today as it was then, and I don't think he would change a word of it today if he could. Before we leave the bet and move on to the next topic, there are some fun and important points that Buffett makes in his letter that I want to highlight. First, he says, "Let me emphasize that there was nothing aberrational about stock market behavior over the 10-year stretch. If a poll of investment experts had been asked late in 2007 for a forecast of long-term common stock returns, their guesses would have likely averaged close to the 8.5% actually delivered by the S&P 500. I'm currently reading a book called The Courage to Act by Ben Bernanke, who was the chairman of the Federal Reserve during the financial crisis of 2008 and 2009. In this book, he recounts the events of the crisis and draws comparisons to the Great Depression and other crises around the world. This was an eventful time in the markets. and the bet started just before the worst market collapse in recent history. So what does Warren mean here when he says there was nothing aberrational about stock market behavior over the 10-year stretch? I'm not so bold to put words in Mr. Buffett's mouth, but what I take away from the statement is that there will be other financial crises. It's a part of the markets and human nature. But even if you put your money in the S&P 500 at the start of the crisis, you can expect to come out ahead over a time period of, say, 10 years or so. The market will correct, and a return of 6, 7, or even 8% can be expected over time, even with the periods of financial turmoil. Perhaps I might put it this way. There's nothing aberrational about doubling your money over 10 years if you invest in a low-cost S&P 500 index fund. Such an important frame of reference and mindset for those looking to get ahead in this world financially. But again, the concept of a longer time horizon is key. In another part of the 2017 letter, Warren Buffett caps it off and puts things in perspective in a way that only Warren can. He says, "The bet illuminated another important investment lesson. Though markets are generally rational, they occasionally do crazy things. Seizing the opportunity when offered does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon such as alpha and beta. What investors then need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period, or even to look foolish, is also essential." Wow, those are powerful words. There's nothing fancy or complicated about investing in a low-cost S&P 500 index. In fact, it can be quite boring, but the performance and outcome is extremely tough to beat. In the first episode, I alluded to a concept called compounding or compounding returns. Why is it so important for investors and for building wealth? Let's illustrate this concept by using a simplified approach with a different type of investment, namely a loan, debt, or bond, so to speak. There's a good summary of bonds on Wikipedia if you need a refresher or perhaps an introduction. A basic bond might be where we give an entity such as the U.S. government or a corporation a sum of money up front, a loan. Per the structure of the bond, they will pay us a periodic payment in interest, perhaps annually. Also, they will pay back our original sum at the end of the stated time frame of the bond. This is just a simple example, and there are other types, structures, etc., but this is a good way to model the power of compounding returns. Now, the trick with compounding is what we do with the annual interest payments that are received. If we reinvest the interest, or in this example, buy more bonds with each interest payment, our investment is now compounding. Let's say at year 0 we buy a $1 bond that will pay 7% interest annually. With each annual interest payment we receive, we buy more bonds or fractions of bonds, also earning 7% annual interest. Note the vertical axis here. I've started it at 75 cents so that we can focus on the interest as it seems small in the beginning. After 1 year, we'll have our original dollar plus 7 cents from interest. Simple enough. If we invest that interest payment, in year 2 we will have our original dollar, the 7 cents we received last year, plus 7 cents for this year's interest payment. But hold on, there's a bit more. We also received 7% interest on the 7 cents received last year. Now on to year 3. We still have our original dollar. We have the interest payments received in years 1 and 2. We now have an interest payment for year 3. We also have the interest on interest from last year. Now this is where things start to get a little exciting. We have 2 additional interest on interest payments, plus an interest on interest payment. From here it gets complicated, but I think you get the picture. Also, I know these additional interest on interest, etc. payments seem small or negligible, but over time they are not, and they really start to add up in a big way. The value of our investment will look something like this over a 10-year period. Note I've realigned the vertical axis such that it starts at 0. With that original dollar invested, we now have a total of $1.97, or almost double what we started with. Again, reinvesting or buying more bonds with each additional bit of interest received. In the chart, the original dollar is in blue and remains unchanged. The simple or direct interest accumulated is in red. This is the 7 cents received every year, and this part grows linearly. Now the gold is the compounding. This is the interest on interest and the interest on interest on interest and so on and so on. You can see how that grows over time. This piece is growing faster and faster with each year. It's curving upward. Now, 7% interest on a debt security or bond would be tough to come by right now. But what if you were able to get 7% interest or 7% compounding returns? What would it look like over a longer time horizon? Again, this is the investment after 10 years. Now let's compound over a period of, say, 68 years, for example. There are a couple of things to point out here. First, notice the upward curvature, where each successive year generates a bigger and bigger return than the previous year due to compounding. Look how far the compounding has outpaced the original investment as well as the simple interest. Does this curve look vaguely familiar? If I overlay the S&P 500, you'll notice a striking similarity. The S&P 500 seems to exhibit the effects of compounding, and in fact, it seems to beat the 7% example with a return somewhere closer to 7.8%. Again, this is only price appreciation. Investors earn dividends along the way as well, but we'll get to that in the future episodes. Now, bonds and stocks are fundamentally different kinds of investments. For example, when we purchase a stock, there is no obligation for the corporation to pay back our original investment. In fact, the only way to really end the investment, so to speak, is to sell our shares in the open market to other investors. If the business fails and goes out of business, our money is gone. Also, there is no obligation for the corporation to pay an annual interest payment, although many do pay a dividend, but again, we'll get to that. So why did I use the example of a debt security or bond to model the returns of the S&P 500 index? How does compounding returns relate to owning stock in a company? Is it just coincidence that the S&P 500 index exhibits the characteristic upward curvature of compounding? Do other types of investments exhibit this same character? It's important to state here that I haven't really provided any cause and effect. We've only noticed an interesting parallel. But we're going to explore this causal connection in the next episode. What's driving the upward curvature for the S&P 500 and what sustains it?